Maybe you can throw your 2 cents in and tell us what you think the Fed should do.
I tell the Fed in private what I think they ought to do, and that's the last I hear of it.
What about this notion of the economy weakening, potentially recession risks picking up? Alan, how do you see the U.S. outlook for the rest of the year?
Strangely enough, it's going to depend in large part on the stock market, because we underestimate the wealth effect on the economy, and this type of volatile stock market moves, it has an impact which I don't think we fully understand nor measure correctly. Overall, the economy seems to be sagging. Longer term, of course, I've made the point that with the entitlement surge as we age in the population, we're draining gross domestic savings from the economy dollar for dollar, the data show. And that implies that it's undercutting capital investment from which is heavily financed by domestic savings. The problem at this stage is that it's not clear where the markets are going, but let's not rule out the fact that they are in and of themselves critical fact. Econometric analysis says effectively that a 10% rise in the S&P 500 has a 1% effect on overall GDP. That is not a small number.
No, it's not. What about the trade war and the tariffs and the fact that we're starting to see it more prominently feature in ISM weakness and manufacturing weakness in this country? How much do you think that is slowing the global economy, and how much do you think it's a headwind for the U.S.?
Well, I think it's, first of all, it's a major global issue. I don't think this thing is caving in, so to speak, but that it's eroding and it's weak, I think, is unquestionable. I think it's important to recognize that if we get major stock market adjustments, we're going to feel it in the economy with a very short lag.
So, I mean, do you think the prospect of, I saw a headline that you were talking about the idea of negative interest rates potentially happening in this country. Do you think that's something possible? And if so, what would it signify?
Well, first of all, what it signifies really is that the world population is aging, and that people are recognizing that they're dying off at a much later date than they originally contemplated when they started to save. And as a result of that, there's been an endeavor to pick up fairly quickly. Like the U.S. Treasury 30-year yield is terrifically useful, I would say, offset to the other things that are going on in the market. It's a real-time asset. And one of the reasons the gold price is rising as fast as it is, at $1,500 a troy ounce, that's telling us essentially that people are looking for basically resources which they know are going to have a value 20 years from now or 30 years from now as they age, and they want to make sure that they have the resources to keep themselves in place. That is a clearly fundamental force that's driving this, but we don't know how far it'll go.
How far, Chairman Greenspan, do you think it could go? To Sarah's question, and others have pointed this out as well, given negative rates around the globe on over $16 trillion in assets. Do you think it could actually visit our shores as well?
Well, it's hardly likely that it's been, for example, take a look at Japan. You can see it, quite visually. as the population goes down. And you can see pretty much throughout the world, it's just a matter of time before it's more in the United States. And I think the issue here is watch the 30-year U.S. Treasury yield. That's going to tell you what's happening.
Although you said in recent days that it's just another number, doesn't necessarily mean it's something symbolic other than it's below zero. Can you expand on that?
Yeah, in other words, basically, we're so used to the fact that we don't have negative interest rates, but if you get a significant change in the attitude of the population, they look for coupon, and as a result of that, there's a tendency to disregard the fact that that has an effect on the net interest rate that they receive. In short, what the buyers of 30-year treasuries now, who are looking for that 30-year away guarantee, they're paying for it up front in the other parts of the valuation process.
Chairman Greenspan, I'd like to come back for a second to this idea that you introduced of the wealth effect of the stock market and how important it is in terms of at least gauging even where rates should be. Do you think the Fed is appropriately sort of measuring the volatility of the market and or the wealth effect or lack thereof at this point in its deliberations about future policy?
I would assume so. They know what's going on much better than the rest of the world, frankly. So I find it very difficult to believe that they're not on this with some degree of analysis.
What do you mean they know what's going on better than the rest of the world?
I'm sorry, try me again.
What do you mean they know what's going on better than everybody else? I mean, that is a question right now about who knows best for the Fed. Is it the president who's calling for easing? Is it the market that is pricing in more aggressive easing? Or is it the Fed itself?
It's the Fed itself. Let me say this. Once a Fed governor gets appointed by the President of the United States, whomever that may be, and then gets essentially voted positively by the Senate, it is very difficult, short of a major malfeasance, to get that person out of that office. There has never been anybody in the history of the Fed who has essentially, basically been taken out of office for malfeasance. I don't think there ever will be.
So you think the chances of the president somehow replacing Fed Chair Powell are nil?
Less than that, if I could find a number.
I assume you've read Dudley's op-ed from a week or two ago. He's got another one out today in which he reiterates that the Fed should essentially not enable the White House's trade tariff policy. Is he over his skis? Can you imagine yourself ever writing something like that?
I'm sorry, who are you referring to?
This is a former Fed Governor Dudley.
Bill Dudley, former New York Fed president.
Oh, well, no. He's a very good economist. You've got to understand that people have different views within the Fed, but what makes the Fed a very effective organization is when it comes together, it has an extraordinary sense of where the economy is going. And having been there for almost 20 years, it doesn't matter who is chairman, it doesn't matter who is in particular positions, but the overall effect of the research operations within the Federal Reserve is nothing short of impressive.
Chairman Greenspan, do you think central banks, especially those in Europe and Japan right now, have the ammunition and the tools to fight another slowdown and potential recession?
I think they're going to have difficulties largely because I think equity prices are going to adjust more than we have had over the past. Remember, we've had a very sharp change in the attitude towards the 30-year Treasury. We originally thought that the 30-year Treasury was going to stay up in the 3% yield area, and it's come down quite unexpectedly because there's been a change in the attitude, the time preference, so to speak, of the population towards seeing that they're going to live longer lives and they're going to need to finance those longer lives well in advance, like now.
Sounds like you're saying the idea of ultra-long paper, which has been floated in the past couple of weeks, could actually happen.
I'm sorry, ultra what?
Ultra-long paper, 50, 100-year-old debt.
No, I've never heard of it, but this is going in the direction. In fact, if I had thought about it, I would say it's inevitable that one of those, there's some place in the marketplace which will try to hedge on something that's extended beyond what we see now. The answer is I have never seen. It sounds awfully bizarre, but so did a 30-year Treasury at under 3%.
And finally, Chairman Greenspan, coming back to equity markets, which you've mentioned a number of times, are you concerned? Are you forecasting in some way some sort of a correction in equity markets?
Well, remember that we're now in a period where if you're a chartist, you're probably getting a little nervous the way the markets behave. But these markets are now so sophisticated that it's other than the general view that there's a bias towards always being invested in common stock or other forms of equity. I won't get into the reasons, but it's a well-known phenomenon. And I think aside from that, as an economic or financial policy, I find it very difficult to pick something out of the market that it does not already know.
A lot of people, Chairman Greenspan, would take issue with your assertion that the Fed knows best, considering, the Fed missed the housing market crisis. I mean, the Fed has missed recessions in various periods of time. And even this Federal Reserve chairman has really pivoted to patient and easing in a pretty quick way following the markets. So how would you respond to some of that criticism?
I would basically say, remember that there is nobody who calls the market correctly all the times. But having watched the way the Fed functions for, as I said, almost 20 years, as an organization, it's the best I've ever seen. And I've been around for quite a long while.